a cash budget with a bit of a difference. I would have struggled with this now myself. This was thrown in as a mock. It's sort of a mixture of a production budget type question around the purchases with the cash budget. It's because they don't really give you the purchases, but they give you enough information to find it out. But we'll see that when we get to it. So just do our sales first as normal. So we're doing July, August, September, October, November, December. You'll see in the question you're only actually getting the marks for September to December. But we're going to put in July and August as well, just to help us along. So 30% will be for immediate cash, and there's a cash discount of 2%. So in reality, we're getting 98% of 30%. So 98% of 30% is 29.4%. So we're going to get 29.4%. And we're going to multiply that by the 800,000. We're going to go across the way. So that's 235,200. Okay, we'll just keep going across the way. So 0.294 by 850. 0.294 by 700,000. And so on. So 0.294 by 800,000 again, so hopefully we get the same answer as before, 235,200. For November, it's 0.294 by 900,000. And for December, it's 0.294 by 850. Okay, 249,900. Again, for those who maybe don't have me here looking at this from a different perspective, you could find 30% of each of the numbers and then find 2% of your answer and take them away. But a 2% discount means you're taking 2% off 30%. It is not 2% off making it 28%. It's 98% of 30% when we're working it out, which is 29.4. Okay, so that's our cash sales. So our credit sales 1 month. So the remaining 70% is from credit customers. These debtors will pay their bills 50% of the month after sale, with the remainder the second month after sale. So it's not 50 and 20, it's 50% off 70%, which is 35% is 1 month, which makes 35% 2 months. It'll be the same number both times. So again, it's 35% of 800,000. We're moving forward 1 month, of course. So it's 280, and you'll have 280 on the next line down. It's obviously the same number, just a month further on. We'll take the 850. So 35% of 850 is 297,500. For October, it's 35% of 700,000. It's 245. For then November, obviously we take the October figure, so it's 35% of 800,000. That's 245,000, and then 280,000. And then for November's one that goes into December, it's 35% of 900,000. So we don't have to go into January. We're going to use January now in a little bit. So we're just going to add those together. We don't really need July and August. Okay, because we're only getting the marks for September, October, November, December. Okay, so I'm just going to put them maybe in a different colour. We're not going to be using those. Alright, so then, normally we then move on to purchases, and we're going to move on to purchases. Okay, and we are told in the question, we're not told purchases here, and we're not told to split it up, but we're told that gross profit is expected to be 40% of sales. So we could suggest then that purchases is 60% of each of those. So sales minus cost of sales is gross profit, right? So let's just move down. We're going to have to do this as a working basically. So for our purchases, it's going to be 60%. Our starting figure is 60% of each of those numbers. So for July, it's going to be 0.6 of the 800,000. Again, just move across for August, 0.6 of 850. For September, it's 0.6 of 700,000. October, 0.6 of 800,000. November, 0.6 of 900,000. And December, 0.6 of 850. And January, 0.6, this is where we're going to need the January later on, 0.6 of 950,000. Again, we're not going to need these numbers. I'll just put them in red. All right, that's fair enough so far. So assuming there was no stocks or anything, they would be the correct numbers, and assuming you were paying them in advance. But it tells us then that stock of finished goods at the beginning of each month will be 20% of the next month's sales requirement. So 20%. So our opening stock is going to be 20% of that month's sales requirements. So our stocks of finished goods at the beginning of the month will be 20% of that month's sales requirements. So we're going to start off with 20% of each of the month's sales requirements. Okay, so that means your closing stock, you just work back a month, has to be the previous month's opening stock. I'm just taking the previous month's opening stock for each of these, and that's why we're going to need the January. So what does all that mean? All right, if you remember, we don't have to buy opening stock, but we do have to buy closing stock. So we're going to take away opening stock. So it's going to be 480. We're going to take away our opening stock and add on our closing stock. And we learned that in our production budget. So we've got 486 there. And we'll just do the same the whole way across with 492, 432, 492, 534, and then we'd have 522 if we were going into December. All right, so they would be our purchases figures. So that's what we're going to purchase each month. All right, but it tells us we're getting 1 month credit, so nothing there. Then we would have 486 here, and then we can work across 492. So each of these is just moving forward one number. So 492 goes to the next month. 432 then after that. 492 again. And then 534. Okay, the 522 will go into January. We don't need to worry about January. All right, so that's our purchases done. That would have, I would imagine, caused a lot of trouble to a lot of people all over Ireland. So you just have to think, where have I seen this before? And you would have seen it before in production budgeting, and you would see it also in cash production, the combo ones. So that's our purchases. So we've done that gross profit, we've done the stock. Now the stock is going to be important. We'll probably have opening stock in our budgeted profit, trading profit and loss account later on. We've done our cash collection. 1 month credit is given. Then we're on to our expenses. So we've got wages. All right, so wages 50,000 plus 3% sales commission. So I am going to split that into wages and commission. You probably should add them together, but wages is 50,000 a month. And we're going to put them in in all of the months there. And then the commission is 3% of sales. So it's 3% of the 800,000. So it's 3% of 800,000. Then it's 3% of 850. Then it's 3% of 700,000. And so on, 3% of 800,000. 3% of 900,000. And then 3% of 850. And that's 25.5. Alright, so that's your wages and commission. The variable overhead is €10 per unit. Now, tenner per unit, we're told the selling price is 10. So we're going to take the 800,000, divide it by 100, multiply by 10. So in reality, it's 1/10 of each of these numbers. So it's 1/10 of 800,000, 1/10 of 850, then 70,000 here. 1/10 of 800,000 again is 80,000. 1/10 of 900,000 is 90,000, and then 850, so 85,000. So we're dividing by 100, multiplying by 10, so 1/10. So that's our variable overhead. Our fixed overhead. So it tells us our fixed overhead is 75,000 a month, but it includes depreciation, and he's buying his equipment on the 1st of the 10th, costing 72,000. So I'm just going to put that in, 1st of the 10th. Oh, sorry, 1st of September. So that's 72,000. So what's he got on the fixed overhead? So it's 72,000. It's got a useful life of 5 years. So the depreciation on the equipment per month is 72,000 divided by 60 months. 60 months in 5 years. So depreciation on equipment per month. So you can do it two ways. I would just go 72,000 divided by 60. Which is 1,200 a month. And that'll give us fixed overheads of 75 minus 12, so 73.8 each month. Sorry, should put them where I had fixed overheads already. Alright, or the other way you could do it, if you didn't want to do that, it'd be 72,000 divided by 5 will give you a year's depreciation. And then take that 14.4 and divide it by 12 months, and you'll get 1,200. Okay, so that's our fixed overhead. I've put in our equipment. To finance, you're going to get a loan of 48,000, so we'll come back to that, secured at 6% per annum. The capital sum is being repaid in 48 monthly instalments, so you're getting a loan repayment each month. And the loan repayment starts on the 1st of October, so it's 48 equal repayments. So 48 divided by 48 is 1,000 a month, so it comes down by 1,000 each month. So that's your repayment. So then how much does he pay in loan interest? So I'm going to just have a look at it. He's paying 6% per year, so 6% of 48,000. So that's 6% of 48,000 will give you a full year. Then you have to divide that by 12 to give you 1 month. So it's 6% of 48,000 divided by 12. That'll give you the first month, which is 2,000. Okay, you're making the first payment in October. So payments, you're getting the loan in September. Sorry, on the 1st of September. So you're going to make the first repayment of interest on the 1st of September. Now then you pay a loan back of 1,000. So we're paying interest on the outstanding amount. So it's going to be 6% for the next one. of 47,000. So instead of being 47,000 or 48, it's 47. So 0.6 by 47,000, and we're going to divide that answer by 12. So it's, Jesus, I've made it complete. Sorry, that should be 6% there of 48. So it should have been 240 here. Jesus, very bad. Sorry. It's gone down by 5 to 235. Now it's going to go down by a fiver each month in effect. So 230 and then 225 the following month. So every month the interest goes down by €5 because in effect, if you just look at it, 6% of 1,000 divided by 12 is a fiver. So every time you pay off 1,000, you have €5 less interest to pay. So that's our loan interest. We don't have to worry about the other months here, obviously, as we're doing them. So that's us done. So we're going to only add up the these ones here, the ones we're doing. Okay. Put them across. Just don't want to confuse matters, so I just think I'll delete these. Now that we have them done. So we've got our expenses there. So that's our total. So our net cash then is our usual receipts, revenues minus payments. So one minus the other. So 783,300 minus 779 is 4260. The following month 7777 minus 661035, 116, and so on and so on. Okay. Net cash, loan, opening cash, and closing cash. So, just bear with me for 1 second, lads. Hello? How are you doing? Yeah, it's 7:30, is it? Yeah, perfect. We'll see you then. Alright, thank you. Bye. Sorry about that, lads. Just had to confirm something. So, anyway, we got the loan on the. I'll try and edit that out of this. We got the loan on. We got a loan of 48,000, so that goes there. We got it on the 1st of September. So then, is there an opening cash now? Hopefully, it tells us the opening cash, because otherwise, we'll be in a bit of trouble. Prepare a cash budget for the 4 months, given that the opening cash on the 1st of September is 13.5. So again, you're just going to have to read that question carefully. It can't be zero because the business exists from July. So then it's net cash plus loan plus opening cash is closing cash, and then away we go with that. And we'll just complete our net cash plus opening cash equals closing cash. Your closing cash for 1 month equals the opening cash in the next, and so on. So our overall position is 387,237,995. Sorry, this is saying I have a different number here. Just want to check that. Why have I got? I'm missing something. 50,000. Seem to have a different number. Let me just check why that is. So that has to be more than that. 5. So 534 plus 75.5 plus 85,000 plus 73.8. I left out the fixed overhead there for some reason. So I was looking, that didn't look right. Anyway, that's 313,370. All right, so they're all our workings. I'm just going to go. I'll do them underneath here. So that's our cash budget. We're asked to do a trading profit and loss account for the 4 months. Now, normally we would put all sorts of things in our trading profit and loss account. This time we have enough to do sales minus cost of sales equals gross profit. So the cost of sales is made up of our opening stock, purchases, and then we have to take away our closing stock. We have value for each of those. Normally in a cash budget we don't. So obviously we doing this, it's telling us what the stock numbers are. So anyway, we go for our sales. So we've got our sales for September, October, November, December is 70,000 plus 800 plus 900 plus 850. So normally you could just work that out. You can't in this case. So it's 700,000 plus 800,000 plus 900,000 plus 950. So that's 337 plus 8 plus 9 plus 850 is 3250. Right, what's the opening stock? So the opening stock figure is the 84,000, right? So the opening stock figure is 20% of the of that month's stock. So we go to we can go to September. So July, August, September. We know that purchases 420,000 and opening stock is 20% of it. It doesn't matter when you pay for it. The opening stock is 20%, so it's the 84,000. Okay, so just be aware of it. You're using the third month, 700,000. 60% of that is 420,000, and then 20% of that is 84,000. Right, so that's our opening stock. Our purchases is September, October, November, December added together. So the 4 here, so 420 plus 480 plus 540. Sorry, it's not, isn't it not? So it's my 432 plus 492 plus 534 plus 522, because obviously you have to buy the closing stock as well. So the purchases is 432 plus 492 plus 534 plus 522. Okay, so each of the figures for September, October, November, December. Okay, so that's 1980. Okay, our closing stock is this 114 at the end here. Okay, and then we can net cash our opening stock plus purchases minus closing stock, and then take them away from each other, and then we get a gross profit of the 1.3 million there. Okay, now from that we have to take away our expenses. I'm just going to run over a little room here, so just add in a few more lines. So less expenses. So we didn't give any discount or anything like that, so we don't have to add on the discount. But we have the discount allowed. So that's our discount. So it's the, no, I should have worked this out earlier, but it's the 4 discounts off these, right? So it's 2% of 30%, so 0.294 of 325. 0.294 of my sales, so of 3250. So it's not 0.294. It's 0.294 would be the cash sales. Sorry, it's 0.02 by 0.3. So 2% of 30% of 3920. So your cash sales element is 30% of 3250, and your discount of that is 2% of your answer. It's 2% of 30% of 3250, which is 19.5. Then we've got our wages. got our commission, we've got our variable overhead, fixed overhead. I'm going to run out of room here, so I'll just add in a few more lines. Variable overhead, fixed overhead, depreciation, and then I'm going to leave out my interest till after my net profit. So my wages are 50,000 by 4 months, 200,000. My commission is 10% of my sales, so 32.5. Was it 10%? That was commission. Sorry, it wasn't 10%, was it? What was commission? 3%. Jesus, I overestimated there big time. Sorry. Sure you picked up on that. So it's 3% of 3250. So 97.5. Okay, my variable overhead then is 70 plus 80 plus 90 plus 850. That's my 3250. 10% of 3250. Oh. So 10% of 32. And then my fixed overhead is 73.8 by 4. And of course my depreciation is the 4 added together. So the depreciation a month we worked out down here to be 1200, so the depreciation is going to be 4,800. So my expenses are 942, which we'll take away to get 358, which will be our operating profit. Of course, we always take our interest away separately. So the interest is 240 plus 235 plus 230 plus 225. That be equals 240 by minus 240 by 4. 240 plus 235 plus 230 plus 225. So that's 930. We're going to have to take that away, and you get your net profit of 357,070. Again, just be careful with all these. Now, this is a question I would have avoided like the plague. I would have been really hoping the cash budgets come up, but then I'd take one look at it and go, Jesus, there's a load of stuff in here. Even the layout of the question, that I'd be thinking, God, I'm going to have to put a bit of work into that. So I'd check what the other question was. The other question was marginal costing, and I would have been doing the marginal costing question. Absolutely. Now, I'm not finished up, so I've got my little bit of theory to do. So part D, explain the difference between a capital budget and a master budget. So the capital budget looks at your planned, I'll come down a bit. So a capital budget looks at your planned expenditure, so it looks at a planned capital spending or income, such as the purchase of fixed assets. Does it say more about them? So who does them? So I suppose a capital budget is designed or is created, what's the right word? Is prepared, Jesus, by the financial controller of a company. I think that should be enough. Okay. So obviously capital spending is the job of the board of directors to decide on capital spending. So a master budget then. So what's a master budget? It's a summary of all other budgets. So it will consist of a budgeted profit and loss account, a budgeted balance sheet, and a budgeted manufacturing account. If the company is a manufacturing company. It will be prepared again by the financial controller. And you'd use it to compare to your actual events at the end of it. So again, as I was saying, Jesus, I would avoid that. It wasn't too difficult really in hindsight, but it would have thrown me in an exam situation in a question I'd like to start with, probably. A nice easy one. So again, I would do I think I would do the marginal costing, but if you're going to do the budgeting, have a look at that. I don't think it'll be asked like that in reality. All right, thanks very much for your attention.